Okay, so for the weights, you will also get an idea of it right here. So this is your Excel project 6, which you will follow my instruction to finish the project. And right here you get prices, the market price for the three securities and the number of units being outstanding. So based on these two columns, you can get the market value for each, and then you sum them up to get a total, and then get the percentage weight. Same way, you're gonna get the total book value and then get a percentage weight. All right. So next, we're gonna discuss this required returns or cost of capital. Okay. First of all, you should know that the cost may change according to the capital level because it's getting harder and harder if you raise more and more capital. Okay. And so the investment banks or any party, financial institutions who is in charge to raise money for you, okay, or the middleman between you and the financial market would charge you more and more money if you ask them to raise higher level capital. All right, here is an exercise for you guys, and it basically asks you to solve for the cost of capital for each component. You have a common stock, information about common stock, and you have information about corporate bond, you have information about a preferred stock. All right, and remember what I just said. It was the cost of capital basically is the holding period return for this type of security. In other words, the return for bond is a cost of a debt. Okay, return of bond is cost of debt. And what is return of bond? You can find yield to maturity in the chapter 7. We have discussed that yield to maturity is the holding period return for corporate bond. All right, so so this one, RD is the marginal cost of debt. All right, and yield to maturity basically is used as RD. And this is the information you had from the problem set. So this is a 15-year, 12% semi-annual corporate bond sales for this market price. So that's your setting in a calculator. So since I have done this time value money solving on and on in previous chapters, so I just show you the result. Okay, you put 30 as n because this is semi-annual. It's 15 years, so you need to times 2 to get a 30 semi-annual periods overall. And then the price and 1,012% coupon rate is given to you. So use 12% times 1,000 face value, and that's going to give you 120. And 120 is for annual coupon payment. You have to divide it by 2 to get a 60. All right. So based on the setting, you get a 5. And remember, this 5 is the number you get after you set a py and a cy in the calculator equal to 1. And in Excel, there's no way you can get other answers except the 5. So 5 is a semi-annual rate. So, but yield to maturity really is the annual term. So you have to convert it. You have to annualize it. So the only thing you need to do here is actually pretty simple. You multiply 5% by 2 from the annual rate. So from semi-annual rate, you get the annual rate of 10%. All right. So that's for cost of debt. And remember, you have to do a after-tax adjustment here. You have to multiply 1 minus the tax rate. Okay. So 40% of the tax rate, and then 6% is your after-tax cost of debt. All right, now let's check the preferred stock. So again, the return of a preferred stock is the cost of the company to raise preferred equity. Okay, so how to get the return of a preferred stock? This is not tax deductible, so you don't have to multiply 1 minus tax rate. So this is the information given to you, and you have a 10% $100 par value, and then your 10% here is not the return of a preferred stock. It looks like so, but it's actually not, because in order to get a preferred stock, you get the return. You really have to rely on the market price of right here is $111.10. That's the market price. So that's based on this one, we get the return. All right, and this 10% is 10% of the face value or par value that is paid each year to shareholders as a fixed amount of dividend payment. All right, so right here, you can twist the formula a little bit. Since in the perpetuity model, your price equals to dividend divided by the required return. All right. If this time you are solving for the required return, the denominator right here, you can just change this formula, and RP would be equal to dividend divided by the price. Okay, so RP equals to DP divided by preferred price. I don't want to say PP though. Okay, so and remember, this dividend is paid quarterly. So 10% times $100, that's $10. That's an annual dividend payment. And for each quarter, you only get a quarter of that. So that's 10 divided by 4, that's 2.3. So if you use the quarterly dividend divided by the full market price of the preferred stock, then this whole thing would give you the quarterly return for the preferred stock. Let me repeat. If you use the quarterly dividend divided by the market price, you would get a quarterly return for the preferred. So how do you annualize that return? Just like what you did for a semi-annual bond, you multiply the semi-annual rate by 2 to get an annual. You multiply the quarterly rate by 4 to get an annual rate. So you get a 9%. Okay? So two things you need to really remember. One is you need to use the market price, okay, not the book value price as the price in your formula. And the second, if this is paid quarterly, initially does not matter, okay? Although I divide by 4 and multiply by 4, and then I got a 10, but the frequency of a dividend payment does not matter. If it's semi-annual, I just divide 10 by 2 and then multiply by 2, okay? Or if it is monthly, divide by 12, multiply by 12, so they all get canceled out. So you can ignore this, okay? Just to use this $10, which comes from 10% times 100, okay, as the numerator to get the return. Okay, the par value is used to calculate the dividend. This $100 is used to calculate dividend, and it's not the market price to solve. So that's probably the third thing I want you guys to remember. All right, the last one here is your cost of common equity or return of the common equity. There are three ways to get the return of the stock. Okay, first you can rely on the CAPM, capital assets pricing model. Okay, in this model you would need to get the risk-free rates, which is the treasury bond rates. You need to get the market return. Okay, and also you should estimate the beta of the firm, and the estimation of beta is your Excel project 5. You should have done that. Another way to get the required return here is to use the dividend divided by the price, then plus G. Okay, this just comes from the formula we have learned before, which is price 0 equals to dividend 1 over R minus G. So if you just twist this formula a little bit, then you will get R equals to dividend 1 over price 0, okay, then hopefully plus G. Okay, so let me zoom in myself a little bit if I can. Okay, so from this formula, you can get this formula for the return. All right. Oops. Oh, sorry for the noise. That's my wheelchair. Okay. All right. And another method here is bond yield plus risk premium. So it's plus, not minus, because for the same company, the stock is riskier than its own bond. Okay, the stock is riskier than its own bond, as I showed you in the last video of this module. Okay, therefore the return for the stock should be higher than the return of the bond of this company. All right, so you need to add a premium to the bond yield, or to the bond return. Yield is return, by the way, to get the stock return. Okay, so we have already solved this RD equals to 10%. You can just add a premium that you feel appropriate. You can just add 4% there. All right. So there are three methods to get cost of equity or return of a stock. Okay. So if you follow CAPM, you have risk-free rate equals to 7%. Risk premium of the market is 6%, and by the way, risk premium of the market is market rate minus risk-free rate. Okay, and the beta is 1.2. Just plug in all the factors, all the numbers into this variables, so you can solve for the individual stock return. Okay, based on the market, based on the risk-free, based on the beta, which is the call movement between market and the stock. All right, the next one is to use the discounted cash flow model, as I have showed you right up there. So you're gonna first, when you have a current stock price and you have a dividend that is not dividend 1, you have to get dividend 1 first. Okay, so this is dividend 0, and you need to solve for dividend 1, as I mentioned multiple times in chapter 9. So dividend 1 is dividend 0 times 1 plus the growth rate of 5%. Okay, that's how you get a dividend 1, and then use the dividend 1 plugged in. Okay, to get the return of the stock or the cost of a common equity. Okay, that's a different number following a different method. And the next one is bond yield plus risk premium. So you just use the bond yield of 10% plus 4% number. You feel this 4% is appropriate, so just add in there. So that's the easiest one. Okay, so we have a three numbers based on three methods, and you can take the mode, you can take the media or mean. So the middle number is the midpoint is 14%. Okay, so that's how you get cost of equity. In your test, I may ask you to use either CAPM or discounted cash flow model or this risk premium method to get cost of equity. I will not ask all three methods to solve all of them at once. Okay, I just pick one of them and ask you to use. Okay, and after you get this cost for each component capital and their weights, okay, these weights are given to you, which is pretty simple. In your Excel project 6, you need to get the weights in percentage. All right. So then what you do here is to use each cost times the weight. You get a product. This is for preferred cost times weight. Okay, and then debt cost times weights. And then you add all three products together to get the weighted average cost of capital. All right. So notes here is a preferred stock more or less risky to investors than debt? Well, the thing is, for debt investment, your payment, your interest is more guaranteed. Okay, so debt is safer and preferred is riskier. Okay, so since the preferred stock is riskier, then the yield to preferred should be higher than yield to debt. Okay, but you have to know that this is after tax. This is after tax. Remember, in our example, our preferred stock has a yield or return of 9%, and the debt has a before tax return of 10%. Okay, but you have to consider the after tax part of it. So after tax cost of debt or return of debt is actually 6%, which is lower than the 9% preferred return. Okay, and also, why is the cost of retained earnings cheaper than cost of issuing new stock? Well, that's very easy to understand. Retained earnings, okay, is the company's own saving account coming from years and years of accumulation of a profit or net income. All right, so if you use your own money, you don't have to pay any investor anything. So that's a cheap way to use as a capital. All right, but if you issue new stock, then you have to convince investors to buy you. Okay, and then you have to give them a dividend that is attractive enough. Okay, and that would also costly enough for the firm. So that's why we say when we use our own money, it's cheaper than ask money from outsiders. Okay, and also if you ask money from outsiders, it's usually a bad signal because the investors, all the outsiders would think the managers would not sell the shares unless the shares are overvalued. Okay? If the shares are undervalued, then the managers would keep the shares for themselves. The managers would not sell the shares to the market. All right? So it just conveys a negative signal. And also, there is a flotation fee charged by underwriters. Who are the underwriters? In Chapter 9, there is a video for initial public offering. Okay, and I use that video to show you how stocks are issued. So during the issuance process, no matter for stock or for bond, there's always an involvement of underwriters. These underwriters are big investment banks like Morgan Stanley, like Goldman Sachs, Credit Suisse, or Deutsche Bank. So they serve as a middleman between the company and the investors in the financial market. Okay, and basically you give a whole chunk of equity to the underwriter or the investment bank or the middleman, whoever you want to call them, and then they just resell your equity in small pieces of shares of a stock to individual investors in the financial market. Okay, and they would charge you a fee for that. They would definitely get commission for floating the market for you. All right, so the flotation cost depends on the firm's risk and the type of capital being raised, of course. If the firm is highly risky, then the flotation cost would be higher because it's harder to convince investors to buy your shares. So the investment banks, the middlemen, would do more job. All right, and also if you raise common equity, since it's riskier than bond, then the flotation cost would be higher for common equity. Okay. And we usually, in our previous examples, we ignore flotation cost. But in your Excel project number 6, we do incorporate flotation cost in our calculation. As you can see, the common stock has 5% flotation cost, and for preferred is 2%, and for bond is 1%. Okay, so how do we put flotation cost in our calculation? Well, the thing is, it's actually pretty simple. If the company charges 15% of a flotation cost, so that basically means for every $100 an investor pays to buy your stock, the company is only getting $85 for capital. Okay, so for every $100 investors pays for a share, the company is only getting $85. The $15 would go to the pocket of the investment bank or the middleman or the underwriter. Okay, so the 15% is how much they charge off the full price of the security, okay, as the underwriting fee. As a result, the company only receive 1 minus flotation, okay, part of the full price. So if the stock price is $50, then the company is only getting 42.50, okay, just because they have to pay 15% of the $50 to the investment bank for the service. Okay, so that's the only thing you need to do. When you incorporate flotation cost, all you need to do is a replacement. Okay, all you need to do is a replacement. You're gonna replace the full price, which was $50, with after flotation price of 42.50. And you should know how you get 42.50. That's the full price times 1 minus the flotation cost percentage.